Liquidity is the lifeblood of crypto. Today, we're going to be breaking down whether or not it could be entering the market. You don't want to miss it. Let's just jump right in. I do want to thank our sponsor today, and that is I Trust Capital, where you guys can get into your own crypto IRA. Some things they are doing that are very beneficial, of course, whether it's gold, silver, all sorts of crypto, is jumping over to their X account. If you're not following them over on X, you should do. This is where they do some of their announcements, including a 2% match on their bonus when you transfer in-kind crypto over to I Trust Capital. So a nice little holiday gift. You guys can do it just by using our link and getting like $100 in a funding reward to get started. Let's go there. Now, we've got a special guest on today. Of course, you have seen Lynn before, Lynn Alden coming in. And if you guys don't follow her on X, make sure and do that. It is Lynn Alden Contact on X. Jumping in. Lynn, you're going to hit 1 million followers soon here. Congratulations. It looks like you might be on your way.
Thanks. Yeah, we'll see how many of them are humans or bots. That's kind of
Right.
the issue with social media these days, but I do appreciate the following.
Isn't that the case? For sure. Hey, listen, you did a great blog over there on the debasement trade. This is on Lynn's blog. A full rundown. I thought this was a real good topic to kind of get into. First of all, what were you trying to nail down? Because I read quite a bit through it, a lot of different angles on this, and of course, at the end, you kind of come up with a fairly succinct summary. But give me a rundown of what you found in this research.
So I think the big focus I was aiming for there was to emphasize that although the debasement trade is kind of becoming more popular terminology these days, and there's more focus on it, this has really been in place for quite a while. I would say fiscal dominance in the U.S. has been in place for probably 6+ years at this point. And then more broadly, going back, of course, decades, there's been pretty persistent debasement. It's not really something that's kind of materializing in the past year or two.
Right.
I think there's just kind of more information dawning on Wall Street and kind of institutions in general that this isn't going to stop anytime soon. The other thing I really focused on was the concept going forward that I think my base case is we're going to see kind of a gradual money printing. People are always kind of asking, when's the next big monetary stimulus? When do you things break? And then we get a ton of liquidity. And while those things can certainly happen, those are certainly possibilities. I think the more likely outcome is that we shift toward a more gradual central bank balance sheet increasing environment, which means that some of the bears don't get the tightening that they might expect, whereas some of the bulls don't get just massive kind of unrestrained liquidity injections that they might hope for.
Okay, so when you say gradual, so granted, the last time we saw quantitative easing, it was in a different frame of the market, obviously dealing with more of a crisis that both the economy was dealing with as well as the United States, well, globally. Do you feel like this is a trajectory that would happen within the trading year of 2026, or you think this could be a multi-year QE?
I think this could be multi-year. I think it's likely to begin in 2026 unless they do something around supplementary leverage ratios more than they already have, which could allow kind of banks to do shadow QE. But aside from that, it looks like we're probably going to get some degree of balance sheet increases in 2026. But I generally agree with how the Fed forecasts it. Which is that they kind of expected their balance sheet's going to grow roughly in line with nominal GDP. And I think that's like the most likely scenario, give or take, where they shift more toward balance sheet increases, but they would kind of say publicly that it's for the purposes of bank liquidity, technical issues, ensuring what they call ample reserves, rather than for the purposes of economic stimulus. And of course, the awkward thing is if you have an environment where you have an increasing balance sheet and inflation still above target, which I expect is probably the environment we're going to see ourselves in next year.
So higher inflation, now you've got easing possibly coming in, will come in. It's just a matter of what that timing is going to look like. When you look at the market of Bitcoin in general, risk assets, isn't that something that Bitcoin and risk assets need, is QE at a fairly brisk flow, or do you feel like they don't need it as much?
Well, I think needs a strong word. I think the way I would describe it is that, at least according to our research, one of the strongest correlates with Bitcoin price action is liquidity. It's arguably the most liquidity sensitive asset that we track, compared to
Yeah.
equities, compared to gold, compared to bonds. It's not the only variable that affects Bitcoin, but it's certainly one of the major variables. Now, historically, it's tracked more global liquidity, and that's actually been pretty good this year. So Bitcoin's kind of underperformed what you'd expect purely looking at global liquidity. However, in the US, we've had pretty tight base liquidity, and that's where a lot of the buying has come from. So without much buying globally, and with quite a bit of buying, mostly from the U.S. institutional side, the drying up of base liquidity here in the U.S., I think, has likely been one of the variables that weighs on it, in addition to
Okay.
potentially kind of a self-fulfilling prophecy around the 4-year cycle. So I do think that as we get, what is probably going to look like better base liquidity next year, all else being equal, that should be supportive of Bitcoin.
So better liquidity. Are you okay? So are you in the camp of 4-year cycle still on cue? No real change in how these cycles have gone in the past, or do you think that has shifted some?
My base case is the 4-year cycle is no longer really relevant. It arguably hasn't been relevant for the past cycle either. Early on, whenever the supply halving happened, that was a very big change to Bitcoin's kind of new supply coming out.
Hmm.
Whereas now, the annual supply inflation rate is well under 1%. It's
Okay.
a lower supply growth than gold, as on a percentage basis. And so I don't really view that as like the main driver anymore. I think there's, potentially some selling around the psychology of the 4-year cycle. But I think at this point, the much bigger factors are number one, liquidity and kind of macro effects, and
Hmm.
two, the rate of selling of long-term existing holders, kind of OG selling pressure
Yeah.
that has been on the other side of the institutions and the microstrategies and the ETFs gobbling it up. I think those are the two really big variables. They affect a lot more than the changing in the kind of per block supply rate.
Okay, so I want to kind of get your opinion on this because we have looked at this from variations of around a lot of different analysts. When you look at Michael Saylor, the strategy that strategy is approaching right now, along with even if you jump over to what's happening with Ethereum and Tom Lee, which is both of which are buying into the market, is strategy on the right path right now? I know you hold MicroStrategy, but would you say in their current position, which has been a fairly devalued stock over at least the last 6 months, what do you think is going to happen here in the next year to 18 months? Do you feel like this is still a positive play for them?
I think going forward, it still makes sense. I mean, if you look at their history since they adopted their Bitcoin strategy in August 2020, they have outperformed the market. And they've managed to outperform Bitcoin, even of
Hmm.
course they've had a very rough few months here. They also, of course, had a very rough 2022. Their overall kind of debt to equity ratio is on the pretty low side. They have an
Hmm.
interest expense to deal with, but it's not really huge compared to the amount of assets they have. Over time, I would like to see treasury companies that have more cash flows, a little bit more like traditional companies that happen to use Bitcoin as a treasury asset. But basically, I think that there has been a demand from the market for levered Bitcoin, and the type of leverage is not callable, that can't be liquidated on a Sunday
Right.
night. And MicroStrategy, I think, has been it's done a good job of providing that to the market. And this summer, when we saw Bitcoin treasury companies at very high MNAVs, MicroStrategy was at 3x, MetaPlanet, I believe, was touching like 8x in June.
Hmm.
We've just seen very high MNAVs across the board. I think it's natural for some of that to get washed out. I think it's natural for the altcoin ones to get washed out. I think some of these kind of tertiary Bitcoin ones also, it makes sense when they get washed out. They're not really that differentiated compared to the large and liquid ones. But I think that the biggest and best still have a market to provide for as we look forward several years.
What do you make of Tom Lee's strategy with BM&R? I mean, they have kind of gone to your direction of creating a revenue source that's multi-tiered, going after whether it's staking or other asset areas in terms of generating revenue. Do you think they're on the right track?
Well, I think it's natural that some entities are going to do the same thing with Ethereum that we've seen with Bitcoin. In general, I view Bitcoin as more of like the asset that kind of meets the qualifications of a treasury strategy. I view the other coins as more trading assets. So I'm certainly more kind of in the Bitcoin camp when it comes to that. I do like again, I do think it's natural for the market to test it out. I would say that when you look at kind of how companies function, you ideally want companies that have cash flow that's uncorrelated to their own treasury. So whether it's kind of earning option income on Bitcoin or Ethereum, or earning staking rewards on Ethereum, that's still heavily correlated income that is kind of tied to their treasury asset. And I just think that the market, that's the environment that that's what the market wants kind of lately until the past couple months. But I think if we look forward, what's going to happen in the next cycle, the next 5 years, I think there's an opportunity for companies that actually have a product and a service, a cash flow that's unrelated to Bitcoin or crypto, that pulls in money, and companies that can kind of stick their retained earnings into assets like Bitcoin.
Right. Well, I mean, that's where you're getting into treasury strategies that would play into publicly traded companies, or even private companies that might end up, trying to go out there and raise capital. So a lot of opportunities there. Okay, so let me ask you, because I know you kind of are on the fence around where interest rates could be going. It's likely that we're going to get a cut this week. Some people are calling it a hawkish cut. And who knows what's going to happen in January. My question is, do you think we will get near zero again, or do you feel like this is never going to happen in terms of an interest rate trajectory?
Well, I don't think we're going to get near zero in an investable time horizon. So let's call it 2 years. I don't think we're going to see near zero. I think we'll get some cuts next year, and we'll go kind of moderately lower. I don't think we're going to get kind of sub 1%, potentially for many, many, many years. I think that was kind of the end of a long-term debt cycle. And going forward, the market's going to demand higher rates than that. Now, technically, the front end of the curve can do practically whatever a central bank wants. It's the long end of the curve that is more set by market prices, unless a central bank does outright yield curve control. But generally, going forward, I expect kind of moderate interest rates, where they're not going to let the interest rates get too high, even if the bond market wants to go there. But they're also, I don't think they're going to have a compelling reason, and neither is the market really going to comfortably let them bring them down to ultra low levels. I think we're more in this kind of range bound state. And if anything, the market wants that. If you look at, for example, bank stocks in Japan, while Japan was doing their negative rate policy and their kind of deep yield curve suppression, their bank stocks were suffering because it's hard to make loans, it's hard to operate and provide credit to the market when you can't make a return on it. And then ironically, as Japan has lifted their interest rates, many people thought it'd be bearish for their markets, but it actually allows, bank stocks in many cases have doubled or tripled. If you look at the large ones there, they're able to make loans again. There's some semblance of a positive yield curve. I think that's more healthy for the market. I think it's actually pretty good for the private sector, and they're really the entity that hurts the most is the sovereign, because that interest expense kind of keeps pouring out into the market.
Right. Yeah, for sure. Well, and that's the concern I have, is because when you've got basically the White House kind of, I won't say manipulating, but definitely getting in their side of the house in terms of of what we'll see with the Fed, and this is in reference to Kevin Hassett possibly going in as the Fed chair. If he goes in, wouldn't that push you into a position where he may get very aggressive on rate cuts in alignment with what President Trump and Scott Bessent have been saying all along?
So he may. I mean, there are 12 voting members on the FOMC, and 7 of them are the board of governors, and 5 of them are regional, bank presidents. And so, over time, they can have more of the votes in their favor, and they, the chairman, has the biggest control over kind of the public microphone of the Fed. But it's still a group decision. So I do think my expectation is they're going to put kind of downward dovish pressure on the Fed, but it's not absolute. And of course, if they were able to push that too hard, it could backfire on them, because their goal is to try to get, the federal government's interest expense down. They're trying to get mortgages down. But just because you cut the short end of the curve doesn't mean that the long end behaves the way that they want it to. And in fact, so far we've kind of seen, as the Fed has cut rates, mortgage rates haven't really come down by the same degree. And if the bond market and the mortgage market kind of loses confidence in the independence of the Fed, they could sell off that long end. And so I think that they're going to probably try to thread that needle where they air dovish, but they still try to retain as much credibility as possible, and they still do have that 12-member, voting group.
Listen, the next few months are going to get very interesting, especially going into next year with all these changes coming out on the Fed for sure. I want to talk about tokenization, because I've got a clip that we've pieced together here from one of the times when you and I were talking about what that future might look like. And then we had some people on from VanEck also asking the same question. I want to play this for you and then get your opinion. Let's go to that clip.
Tokenized real world assets are going nowhere. They're just adding additional cost and complexity. The yields that you can get on an on-chain T-bill are less than what you can get in an actual T-bill. It's just not a very interesting product right now, neither for the issuer nor for the buyer.
What is your opinion on tokenized treasuries?
So I have a constructive view on them. You can go out and buy a global asset that's better than what is available in your own country. Makes savings and investing more accessible globally. I do think that this idea has legs.
Speaking of the VanEck Treasury Fund, I'm looking right at it right now.
It was born out of customer demand.
All right. I know Matthew, good friend, but he was wrong there. And Lynn, you were right. So here we are edging in over $9 billion now on tokenized treasuries. We're continuing to see accelerated growth across the market. Do you feel like this narrative that almost everybody on Wall Street is championing now takes away from Bitcoin in general?
For the most part, no, because I think they're two different markets. I think one serves kind of near-term and intermediate-term capital. Kind of this, it's similar reason. Do T-bills take away from gold? I would say not really. Gold protects against long-term debasement, but of course its price can fluctuate in the near term. Whereas T-bills are pretty reliable for maintaining purchasing power in the near term, but are virtually guaranteed to lose purchasing power over the long term. And I think that in the digital asset space, Bitcoin and then that whole complex of stable coins and interest-bearing stable coins and things like that, that's pretty much a similar dynamic. The stable coin aspect is good for payments. It's good for near-term working capital. It's good for people around the world that want dollars or want T-bills and want things like that that have trouble accessing in their market. Whereas, in the United States, many of us, of course, can access these things quite easily. And so it just kind of brings that to entities that otherwise would have trouble with the overhead cost of having access to those things.
So Lynn, you mentioned gold there and the comparison. I look at it this way. I know obviously there was the big debate between Schiff and CZ here recently. I think CZ won the debate, but at the same time it revealed something maybe from the gold camp around tokenized gold. And if tokenized gold actually becomes a thing, because we've already seen growth with Paxos, obviously with XAUT, with Tether, continuing to go. And the more we talk to gold people, on this channel, I'm realizing that they may go the route of tokenized gold versus the route of Bitcoin. Does Bitcoin need that kind of liquidity coming out of the gold market at some point to be able to truly grow, or would that possibly cause a slowdown in maybe the top cap side for Bitcoin?
So I view Bitcoin and gold as able to grow independently. If you look at kind of global assets, there's hundreds of trillions of dollars of liquid, global financial assets. Gold has been, like 2% or so, maybe now 3% after the bull run of those assets. Bitcoin has been a tenth of that, so 0.2%. Or lower in many cases. And so I view them both as able to grow into things like the bond market, into the equity market, potentially into the real estate market. And so I don't really view them as competition. That's why I've been long both for many, many years. I do think that tokenized gold has legs. There is funny. There was a period of time where gold enthusiasts would say, well, why not just do this with gold? And I would say it already exists. There already are these kind of gold-backed stablecoins. And for a while, they were a small market. Now they're getting bigger. They're still small in the grand scheme of ththings.
Sure.
But they make sense. It's kind of like how, again, in the United States, people can buy a gold ETF. But if you're in country XYZ, you might not have, a place you can buy that. Or if you do, you might not trust it. And so it kind of allows, just like how stable coins allow pretty much anyone in the, anyone with a smartphone to have kind of the equivalent of an offshore bank account. It's kind of like that with an offshore gold vault account. There's still a chain of custody that they trust, but they're trusting that entity that is outside of their own country and their own kind of maybe inflationary kind of and legal environment that they exist in. So as long as they trust the chain of regulations and custody that they're investing in overseas, I think it's a valuable option for them. It's basically a cross-border gold ETF with the pros and cons that come with it. So I do think that's a growing market. I just view it as separate from Bitcoin. So I there's all this kind of obviously multi-year debate between Bitcoin and gold, and I just think that they have different properties, and that they can both serve a role in the portfolio. I think that Bitcoin's the faster horse because it's newer, it's kind of growing into whatever total addressable market it can be. But that comes with higher volatility, that comes with higher uncertainty, and people can kind of pick the ratio that makes sense for them.
Are you in the camp right now in terms, obviously what you've stated here today is that 4-year cycle, not so much. Do you think that we would see another all-time high in 2026? Do you feel like there's a market brewing for that currently, especially on Bitcoin?
I think in 2026 or 2027, we'll see a new all-time high in Bitcoin. I'd be less confident to say, if it happens in the 12 months or so. Bitcoin, I mean, something like a 30% move can happen very quickly in Bitcoin.
Right.
There's all sorts of things that can change quickly. So I wouldn't try to guess too much that. I do think that going forward, the 4-year cycle has really no bearing on the asset. It's mostly things like liquidity on the demand side and things like OG selling pressure on the supply side, and how those things are going to work together. There's also there's increasing discussions around sovereign buying, as mentioned by BlackRock and others,
Right.
and I think that'll be an ongoing multi-year factor. So I think it's healthy for Bitcoin to get off of this 4-year clock that it's been on. Ideally, as a monetary asset grows and as the supply having becomes a relevant percentage of supply, you don't want a money that kind of goes up and down on 4-year cycles. So I think it's gonna mature in a similar way that gold has no particular clock that moves its price around.
That's
I think
a good
Bitcoin's
point.
going to behave similarly.
Yeah, that's a good point. I'm looking at your multi-asset portfolio here. We'll go into the primarily areas I want to look at, which is the growth stocks. One of them that we see, of course, is PayPal, obviously because of their stablecoin, innovation that they've done with PYUSD. They're starting to break into some blockchain. But you look at two major companies that could go IPO soon, and that would be someone like a Paxos or also Polymarket. Would those be considerations for you if let's say Polymarket and Paxos both went public? Would you potentially put them in your growth stocks category?
Potentially, that would depend on valuation. For the growth stocks category, I tend to look at profitable companies that have kind of reasonable earnings multiples relative to their growth, so good price to earnings to growth ratios. I've avoided Circle, despite otherwise being bullish on stablecoins, and so it would really depend on what they look like when they come to market. But to the extent that they have growing revenues and growing product market fit, and that they trade at reasonable multiples. Probably. I would suspect that they'd be probably new and therefore expensive relative to what I would look to pay. But yeah, I would certainly evaluate them.
You've got Google in here with Alphabet, a trade. It's about 8% of your 12% slot here. When you look at the trade right now that it centers around AI, and even if you look at the PE on NVIDIA or someone like that, a lot of these AI companies, the PE is interesting when you look at what the upside could be. Is there an AI trade still available out there?
I think there is. It depends on where you look. For that Alphabet position, I actually recently reduced that from 12% to 8% of that particular slice of the pie. And that's because my thesis largely played out. There was a while where people were saying that Alphabet was going to be disrupted by AI, whereas I viewed that they still had a pretty good lock, and that the types of search that AI was eating into is mostly the non-profitable search. If someone's curious, they want to know what is Napoleon's wife name. They might look that up. Google doesn't care if they lose that market share because they're not going to make money on that. They make money on things like a plumber near me, right? That's the type of search they care about. They also, of course, have their very own powerful AI business, which in recent months has gotten kind of credit finally.
Much better.
And so as that kind of played out, as that kind of stock ran up pretty quickly, that's when I started to trim back the position where I'm not bearish on it, but kind of the bullish thesis played out. Same thing for some of the chip stocks like NVIDIA and AMD. I still think there's areas to play. I think one of the ones I'm watching that I'm not sure about yet, but I'm watching it closely is Adobe, because they're in the same camp where they're kind of viewed as heavily threatened by AI, and I certainly do think that's a variable. But as they get cheap enough, I think they get more and more interesting. So we'll see how that plays out. I would say I'm a low conviction bull on Adobe. And would look to see signs of a bottom and signs that they're maybe more resilient than the market expects. But we'll see.
that'll be the question. I guess I agree with you. I think a lot of people counted Google out. Gemini's updates here recently have been pretty significant. And then, of course, OpenAI struggled because it looks like they're going to be ending up on more of the retail side where we get enterprise starting to play into it. Google could win that game very quickly, for sure. One last couple of questions I want to hit on. One is this right here. I'm looking at Zcash, And we saw this big run up. And then here recently, we saw a massive fall off. Do you think that pump is finally over and we're going to see that liquidity coming back into the market on traditional assets like Bitcoin, Ethereum, et cetera?
Well, yeah, I would caution people about investing and following these massive pumps. Often you'll see kind of a lot of enthusiasm, sometimes even coordination around a specific asset. I think that the overall traction is still obviously very limited. I kind of reiterate that outside of Bitcoin and outside of the growth of stable coins and kind of, certain real world assets like, again, tokenized gold and things like that, I'm pretty cautious on the whole space. I think I'd be very careful chasing any of those other assets. And I think that generally speaking, over the long term, the inclination is down relative to Bitcoin.
Okay. Last question. Is this a time to DCA? Bitcoin trading literally as we record at around 90K. Is this a DCA time for Bitcoin?
I think so. And almost by definition, if someone's dollar cost averaging, it's always the right time. That's the kind of point, is you're not really trying to time the market. I think it's more of a question of, is it time to accelerate the DCA a little bit? Generally speaking, when the sentiment comes off, we've seen the Bitcoin Treasury MNAVs disappear. We've seen some of the metrics I look at, like market value compared to on-chain cost bases, that is compressed quite significantly.
Right.
Makes it a lot more attractive. Overall enthusiasm is elsewhere. It's on AI, it's on gold. Public sentiment around Bitcoin is pretty low. I generally think this is the time to lean into it. Now, investors obviously have to know their own volatility thresholds. But I think as a larger slice of a portfolio, I think it makes sense to buy the fear rather than kind of buy the enthusiasm.
All right, Lynn, it's always fun chatting with you. Thank you so much for coming in today. Again, just a reminder, jump over on X, Lynn Alden Contact. You can get some of her news there. Jump into her blog. She does a great job on everything in terms of your analysis. So thanks again for coming in today. We appreciate it.
Thank you.
You bet. All right, you guys know what to do. If you're not in the Bear Market Edge, that's our own private group that you can be a part of. Absolutely free. We drop additional research that we do here, insights. And of course, you can also get my newsletter that I drop once a week. We do a little bit of analysis based on all the research our team does to get this show put together. And of course, follow me out there on X at Paul Barron. We'll catch you next time right here on The Paul Barron Show.